Welcome to PPP loans and the Employee Retention Credit, the 2021 version. Yes, we had PPP loans and an Employee Retention Credit in 2020. These have been revised, modified, expanded a little bit. And so we're here to talk to you about what is going on and what is available for businesses in terms of economic relief in these difficult times. My name is Erica Horn. I am a tax associate director at Dean Dorton. Professionally, I've been in the business longer than I care to acknowledge, see gray hair. And I have practiced primarily in the area of state and local tax and state and local tax controversy. So if you have Kentucky or other state questions about income tax or tangible personal property tax or sales and use tax or anything else that has the word tax, fee, assessment, charge, I'm your gal. So that is what I do normally in this COVID era. I, along with my colleagues today, Maddie and John, have taken on a special role at the firm. I don't think Maddie volunteered, but John and I are questioning why we volunteered to learn about these programs to be able to assist our clients and the business community generally with these difficult times again. So, Maddie, what about you? What do you do when you're not doing the employee retention credit and other stimulus things?
Right. Sure. Thanks, Erica. So my name is Maddie Schueler. I'm a senior tax consultant at Dean Dorton. And when I'm not doing the employee retention credit or helping Erica and John as much as I can with PPP loans, I also practice, do some state and local tax work with Erica, and also do some federal consulting as well. So I do a lot of advising and consulting work with the firm, again, outside of our COVID duties. So with that, I'll pass it along to John.
Yeah, well, thanks to everybody for joining us today. My name is John Wurtenberger. As Erica mentioned, PPP loans is just kind of a voluntary side gig, quote unquote, that Erica and I signed up for at the beginning of COVID back in March 2020. And honestly, as much as we complain about it and act surprised that we're still sitting here a year later, working on PPP loans, I really have enjoyed it just from a learning perspective and the questions and the interaction that we're getting with clients. So it really has been a blessing just to be able to assist people as much as we've been able to over the past year. Outside of PPP loans, I am an assurance director within the firm. So I specialize in assisting clients with kind of compliance related services when you think about assurance. So audits, reviews, compilations. I also try to develop, meaningful kind of business advising relationships with our clients. So I try to be a consultant and an advisor as much as I can and connect them with people within the firm that can help regardless of their issues, whether that's something related to internal audit or wealth management or simply something tax related like Erica and Maddie. If there's a state and local tax issue, they're our firm experts.
Thanks, John. And you make a really good point. It has been a unique opportunity to really help people. I don't think we think of CPA or finance as a helping profession, although there are a lot of elements of that. But when you hear the anxiety and distress that business folks are facing today, and you can do a little bit to help, that's been a real gift. I would agree with you on that. Here's the standard disclaimer. Don't take our advice unless you talk to somebody specific about your situation, because every situation and the facts specific to that situation could change something that you may hear or see in our slides. So here we go. The Consolidated Appropriations Act 2021. You've probably heard that it was 5,000 pages. You may have heard it was 2,100 pages. The difference is double space and single space, basically. So the double spaced version, which is far easier to read, is 5,000 pages, and the single spaced version is 2,100 pages. This is the act that Congress does that authorizes all the spending for the various departments of government throughout the United States. So everything from defense to homeland security, health, education, welfare, you name it, the spending is authorized and dictated by the Appropriations Act. And then scattered throughout this particular Appropriations Act are various pieces of economic relief for businesses, small businesses, large businesses, airlines, colleges and universities, hospitals, etc. And the ones that we're going to focus on, as you already know by the title, is the Paycheck Protection Program and the Employee Retention Credit. So in this huge bill, it has a bunch of divisions. So the bill is divided up into divisions. There are 32 of them, divisions A through double F. Each division has a number of titles. So if we're looking at the Paycheck Protection Program, it's in Division N. The title of Division N is Additional Coronavirus Response and Relief. The PPP loans are in Title III, continuing the Paycheck Protection Program and other small business support. And then it has a short title that is as long as the regular title. So I don't know who thinks it's short, but theoretically it's short. Economic Aid to Hard-Hit Small Businesses, Nonprofits and Venues Act, or the Economic Aid Act, you'll often see it referred to. It reauthorizes first draw loans, meaning that people who haven't gotten a PPP loan before can get PPP loans now. And it also makes some changes related to the first round of loans, or the first draws as they're called. And it authorizes a second PPP loan for folks, businesses that meet the eligibility requirements more near PPP. So that tells you a little bit about Division N, the sections we're going to focus on. And then in Division double E, not last, but next to last, is the Taxpayer Certainty and Disaster Relief Act of 2020. Thank goodness they didn't try to do a shorter title for that, because I'm not sure what it would have been. This is where you'll find in Title II retroactive changes to the 2020 Employee Retention Credit and a new authorization of the credit for 2021. Maddie is going to talk about those credits. They have the possibility of being incredibly beneficial to businesses that meet the eligibility requirements. So just a little bit of an overview before John gets started on the details of the PPP loan. When we did this in April of 2020, many people referred to the Paycheck Protection Program as something like a plane being built mid-flight. And that's because it felt like every day SBA, who administers the program with the Department of Treasury, was issuing new guidance, and it was exhausting. This time, because they already had guidance, they were able to get out guidance earlier. So we already have 3 or 4 sources of guidance, John. We have interim final rules, which are the equivalent of an agency's regulations under a statute. And then we have the loan application when someone wants to apply, and that has instructions that are instructive, believe it or not. And then for both the first and the second round, or first and second draw loans, SBA has put out a document called How to Calculate the Maximum Loan Amount and What Documentation to Provide by Business Type. And that might be one of the most helpful documents that you'll see.
I think it's also important just to point out too, Erica, aside from these documents that we've listed on the slides, there's a slew of other information out there when you think about all the IFRs and all the FAQs and all the stuff that came out since the CARES Act back in March 2020. And what we've really tried to highlight on these slides is specific to recently issued guidance and relevant guidance for the changes to the first round or the first draw loans, as well as the second draw loans. Is that right?
That is right. And to that point, I think what we've shown you here was issued between January 15th and the 21st. The first consolidated IFR you see there under the second bullet is an attempt by SBA to put the 25 IFRs that they issued the first time into one comprehensive document. But every once in a while, it'll say, see the prior IFR. So that leaves you a little bit like, well, I thought you were going to tell me everything I needed to know. I can't remember. There's well over 100, maybe almost 200 FAQs for the first program, which they said that they would try to update as soon as practicable to include the changes made by the Economic Aid Act and to provide guidance on the second program. The affiliation rules, which are incredibly important for borrowers, are the affiliation rules that apply to SBA, many SBA loans. Generally, there is a separate IFR on those, and John will talk about those. And then also lenders, those who are making the loans, get separate guidance in the form of procedural notices. And the three that we've listed here, we'll talk about as we go along, are the ones that have import. And you know what, John, something else we should say is that all of these documents, my understanding is there'll be links that you all can go to. But if you go to the Department of Treasury's website and look for PPP loans, all of these documents are on that website. That's a little bit easier to navigate than SBA.
Yep, that's right.
So Maddie, do you have any guidance? Does the IRS have any guidance on the employee retention tax credit?
There is. And, it was funny when you said the name or the title of the act, the Taxpayer Certainty and Disaster Relief Tax Act. I almost had to chuckle to myself because I feel like this has all been anything but certain throughout this process since March. But the IRS has been good about putting out some really good guidance on the employee retention credit. They have numerous, I think it's 100 or more FAQs on the employee retention credit on their website. So there's a whole section of the IRS website that's dedicated to coronavirus and has guidance on the employee retention credit as well as other tax changes. So there are numerous FAQs on there. I will say they have not been updated yet for the Taxpayer Certainty and Disaster Relief Tax Act. We're still waiting for the IRS to update those. So many of those FAQs still hold true. They dealt with portions of the credit that weren't necessarily changed by that act, but there are other parts that do need to be updated. And in fact, if you go there, you'll notice the IRS has a little disclaimer at the top that notes that the FAQs are not updated at this point. In addition, the IRS issued just a short blurb, which I'll talk a little bit more about in my section, that provides guidance for some limited groups of employers who can claim the employee retention credit, sort of do these kind of catch-ups on the employee retention credit for prior quarters on their fourth quarter 941. And again, that will make a little bit more sense when we get into the meat of things with the credit. And then also the IRS has some forms that the instructions to those forms are helpful. So Form 7200, which I'll talk about in a bit, that allowed some employers to get an advance payment on the credit. And if you read through the instructions to that form, those are helpful as well as the instructions to Form 941, which is how most employers would claim the credit. And those instructions contain some helpful information. So the IRS has done a good job about getting out helpful guidance to taxpayers.
So John, you want to tell us about First Draw Paycheck Protection Program loans?
Yeah, I'm happy to. Yeah. And I will say, just for the viewers out there, in addition to helping Erica and Maddie out during this presentation, I'm also the slide master. So if you have any issues or complaints regarding how frequently or maybe a delay in moving forward in the slides, please direct those at me. So First Draw loans. So as Erica mentioned, the Economic Aid Act introduced a lot of information for us, but the two main things that it really did was, provide changes to the First Draw loans, as well as establishing the Second Draw loan program, which we'll get into in just a few minutes. But what's new for the first draw loan? So aside from the bullets that we'll go over on the next few slides, there are, I'm sure, a slew of other minor little things that change with the PPP loans for the first draw. But we tried to really touch on the most significant ones for the purposes of the webinar here today. So the first and foremost, the program end date was extended. So initially that was scheduled to end on December 31st, 2020. The program end date has now been extended to March 31st, 2021. So borrowers just were able to start applying for first draw loans again, either last week, I think it was last week, Erica, or maybe even the week before, depending on what bank you went with. And then they have the ability to, as of right now, continue to apply and receive those loans through the end of March. It also introduced new borrower eligibility. So previously, the entities that were eligible were limited to certain business concerns that had less than 500 employees. It had nonprofit organizations, but it also opened it up to housing cooperatives, destination marketing organizations, 501c6 organizations, and news organizations. So those four entities that previously were ineligible to receive a first draw loan, they have now brought those entities into the fold and allowed them to apply for and receive a first draw loan. So there are specific definitions to what these entities are within the Economic Aid Act. So if you have questions regarding exactly what is a housing cooperative, what is a destination marketing organization, please feel free to reach out. Let us know. We're happy to help. I will say if you're viewing this today and you're a 501c6 organization, there are certain limitations and criteria that you need to achieve in order to apply and be eligible for a first draw loan. Those really stem around how significant are any political lobbying activities to your organization. So you'll want to make sure that you're paying attention to that and evaluating that before going and applying for a first draw loan. In addition, the Economic Aid Act also introduced a new definition of the covered period. So previously, the covered period technically was defined as either the 8-week or the 24-week period, beginning on the date that you received your PPP loan proceeds, and then ending either 8 weeks subsequent to that date or 24 weeks subsequent to that date. There was a little confusion initially because the SBA came out and said that borrowers could apply early before their 24-week end period. So did that give the borrowers the ability to cut off their covered period before the end of 24 weeks, or did it not? They really come out and clarified that within the new Economic Aid Act, and basically gave borrowers the ability to choose an end date for their covered period that is either between 8 weeks after they receive their loan proceeds or 24 weeks after. So the begin date hasn't changed. The begin date will still be the date of which a borrower received their PPP loan proceeds, but the end date can be any date between 8 weeks after receipt of loan proceeds, or the last date would be 24 weeks after a borrower has received their loan proceeds.
And John, that's the same definition of covered period for second draw loans, correct?
It's the same definition, yes, for covered period for second draw loans. Yes, thank you, Erica. And then also keeping in the theme of the covered period, giving borrowers the ability to choose the end date of their covered period, they also took away the previous alternative covered period that borrowers had to use for payroll costs. So if you recall, this was first introduced, I think, when they came out with the loan application, or the loan forgiveness application forms. And what it was meant is really for an administrative convenience for borrowers to choose, a covered period specifically for payroll that coincided with their payroll dates, so that people didn't have to cut things off and do pro rata allocations between payroll periods. With the ability now for borrowers to choose an end date for the covered period, they remove that alternative covered period, and that is actually you'll see that no longer part of the loan forgiveness application with the new application forms that are out there currently. In addition to the expanded eligible borrowers, first draw loans are now brought into scope more expenditures that are both allowable and forgivable for borrowers who received a first draw loan and a second draw loan. Keeping consistent with Erica's previous question, this is both for first draw and second draw. But those expanded eligible expenditures really pertain to operational cost, property damage cost, and supplier costs for essential supplies, as well as worker protection expenses. So again, thinking back to those destination marketing organizations, those housing cooperatives, news organizations, these new eligible expenditures are clearly defined in the Economic Aid Act. And so if you have questions over those, please let us know. But, operational cost, high level overview really pertains to technology software that's used to operate your business, whether that be supply chain, accounting, operational type activities. Property damage costs relate to damage to your property that you incurred as a result of public disturbance that wasn't covered already by an insurance claim. Supplier costs for essential supplies. So you think about during the covered period, if you purchased essential supplies to your business or perishable supplies to your business that relate to a purchase order or a contract that was in place prior to the covered period, those are now allowable and eligible expenditures. And then worker protection expenses. So, masks, hand sanitizers, those plexiglass barriers that seem to be everywhere now. Those types of expenses, if you had to purchase anything for your workers, for your employees, or your office or workspace, those are now allowable and eligible expenditures as well. So the bottom point here related to tax deductibility, this is a big one, and I know that this got a lot of press when the bill was first introduced and enacted, but there were rumors of this in the fall, but now it's actually come to fruition through the enactment of the bill. The expenses that people spend their PPP loan proceeds on are now deductible for federal tax return purposes. So previously, when the CARES Act came out and was enacted, they said that the expenses would not be deductible on the 2020 returns. They said that the forgiven loans would not be included in gross income. So that has stayed consistent. But the thing that has changed is that the expenses are now deductible on your federal tax return. And I say federal tax return for a specific point because what we're seeing, at least right now, is that there is variation at the state level between what the states are deciding to allow for deductibility, and that may coincide with federal and it may not. So some states might say, okay, we understand that you're now allowed to deduct those expenses for federal tax return purposes, but we are still going to tax you on those, and those are not deductible at the state level. So for the borrowers and the people in the audience for this webinar today, if you file your tax return in multiple states and you have PPP loan expenses that you've incurred and paid, you need to be mindful that you might need to look at a state-by-state basis in order to understand whether those expenses are deductible or not deductible, and they don't just automatically follow the federal returns.
Yeah, Maddie, I don't know if you would agree, but right now there's no real trend as to what the states are going to do. If we were going to see a majority, like the majority of states, I would say the majority of states haven't said anything about what they're going to do.
I think that's right. Yeah, I think that's exactly right. A lot of, we've actually found, some states on their websites will have some guidance, but for a lot of states, there just isn't anything yet. And so I think that's a really good point.
Yeah, and I think that it just goes back to the point of just monitor it up until the day that you're hitting submit or mailing in that tax return. Because if there's no guidance out there right now, there could be guidance that's coming out. If they're saying that it's deductible or not deductible right now, I guess that still has the potential to change. And so you just want to make sure that you're monitoring that and you're up to speed on whether those are deductible prior to filing your returns. All right, so another big highlight for first draw loans, and again, second draw loans as well, because this simplified loan forgiveness process applies to both, is the introduction of a more simplified forgiveness process for loans that are $150,000 or less. So again, thinking back to the fall, there were rumors around this. Would there be, a quote unquote auto forgiveness process for first draw loans that were at a certain threshold? While it's by no means an auto forgiveness process, it is a more simplified process. And so the SBA has come out and released a new revised form, which is the 3508S. And I say revised because that 3508S form was actually issued last fall and pertained to loan amounts of $50,000 or less. But it has since been revised to include loan amounts of $150,000 or less and a new simplified process for those borrowers. So what that is essentially is it's a one-page certification that the borrower just needs to fill out and provide some general information about their entity and their loan, including the number of employees that they were able to retain from receiving their loan proceeds, the total loan amount that they received, and the estimated payroll costs that they were able to spend with their loan proceeds. There's also some certifications that they complied with all the SBA 7A rules and that the information included on the certification is accurate. One of the great things I think that pertains to this form is that they eliminated really the additional documentation requirements that a borrower needs to submit when they're applying for forgiveness. So aside from just filling out the certification, there's really no other documentation that a borrower needs to include when submitting this form. There's no copies of payroll reports or bank statements, Form 941s, FTE calculations, anything like that. It's simply just the one-page certification that the borrower is filling out. Now, when I say it's not really an auto forgiveness process, it still has to go through the lender's review. It still has to go through the SBA's review. That doesn't alleviate the potential for SBA to come back and say, hey, I'd like to take a look at this loan a little bit closer. We'd like to audit or quote unquote review that loan. So that doesn't eliminate that potential for the SBA to come back and audit or review your loan just because it's at $150,000 or less. That could still happen, but it is a much more, much more simplified loan process.
And John, the length of time for loans under 150,000, the length of time that a borrower has to maintain all that documentation. So even though they don't have to file it with their forgiveness application, they still have to maintain it. That changed as well, correct?
It did, yes. And so if it relates to payroll type documentation, you just need to retain that information for a period of 4 years. And then all other information associated with your loan forgiveness application, your loan, what you spent the loan proceeds on, you need to retain that documentation for 3 years. And so that 4 and 3 year period, when you think about payroll documentation and all other documentation respectively, that only relates to the 3508S simplified forms. The 6 year documentation retention requirement is still in effect and still applies to the other loan forgiveness forms out there that are the 3508 and the 3508EZ forms.
Thanks.
So the last thing that we want to mention here as it relates to changes with first draw loans is the ability for a borrower to go in and apply for increases to their first draw amounts if they meet certain criteria. So as Erica mentioned earlier, when the program was first introduced and started, it was very much like building an airplane while you're in mid-flight. And so there was a lot of guidance that wasn't available initially when borrowers were going and applying for their loans back in April 2020. And so a lot of that guidance came out subsequent, clarified some points, some questions that people had, and in certain circumstances actually could potentially change the loan amount that a borrower initially received under a first draw loan. So when the Economic Aid Act was enacted, it basically allowed borrowers who met certain criteria the ability to go back and apply for an incremental loan under the first draw program. And so those borrowers that can do that are borrowers who did not initially accept the full amount. So think if you applied for a loan of $300,000, you got approved for a loan of $300,000. But before your lender actually remitted those loan proceeds to you, you said, hold off, I don't want the full 300, I would like 250,000, and you took 250,000. A borrower can now go back and apply for that incremental 50,000 with their lender and receive that 50,000 under the changes that were enacted from the Economic Aid Act. In addition, borrowers that returned a portion of their first draw loan. So same scenario, you applied, received a loan of 300,000, but once the lender remitted that loan amount to you, you actually said, no, I don't want this full amount. I only want $200,000. Well, now you can go back and you can apply for that incremental loan amount as well. And then the additional guidance that came out resulting from changes in IFRs that may have impacted a borrower's PPP loan amount that they initially calculated and received for a first draw loan, they can go back and potentially apply for an increased loan size as well. And what those really relate to are borrowers that are either partnerships or seasonal businesses. So the subsequent IFR changes that came out related to those two entities really, for partnerships, it expressly stated that general partners within a partnership should be included in their partnership's overall loan application, and then also allowed for seasonal borrowers some flexibility in choosing the date range for 2019 payroll costs if they were going to use 2019. And so both of those items could have resulted in increased loan sizes for first draw loans for those borrowers. So now they can go back, they can recalculate what that increased loan size might have been, work with the lender to go in and apply for an increased amount there.
Yeah, as of right now, John, the only guidance per se on getting that increase is to lenders.
Right.
And it remains to be seen whether or not SBA will issue guidance for borrowers on this. So we are just encouraging everyone to reach out to their lender to see what they can do if they find themselves in this situation.
That's right, Erica. And we're actually, and I've seen at least a few questions on this around borrowers who maybe, didn't include everything that they should have included in their first loan calculation, and are now going back and saying, well, I should have included my employer contributions for retirement or healthcare costs that I didn't include. So that would have, given me an extra $50,000 or so. Unfortunately, with those calculation error type issues that people are bringing up, as it stands right now within the guidance that's out there that Erica mentioned to lenders, it doesn't seem like those type of borrowers would be able to go back and apply for an incremental loan size. But we'll wait and see if there's any additional guidance that comes out that may allow for those types of changes. All right, one other thing related to the Economic Aid Act and really kind of first draw and second draw loans is relation to farmers and ranchers. So they specifically came out and said that the first draw loan amount for farmers and ranchers may be increased. They basically clarified the eligibility criteria there for the farmer and rancher to either be a sole proprietor, independent contractor, or self-employed individual. Those individuals that file a Schedule F, and then you have to have been in business as of February 15, 2020. And Erica, I think that in business as of February 15, 2020 isn't just specific to farmers and ranchers. It's really for all borrowers across the board, correct?
Right. It's program wide, as the program has attempted to take care of folks that are damaged by COVID-19. And that's sort of the date. February 15th is kind of the date that most government agencies have chosen as the start date of the virus and its impacts.
That's right. Right. And so, yeah. So what they said about the loan amount for farmers and ranchers, if you have no employees, one, it's based on your 2019 gross income, or you could use 2020 if you so choose. Now, for people that are, and that's really one of the things for borrowers and first draw or second draw loans too, that they came out and said, you can use 2019 calendar year, you can use 2020 calendar year, but the forms that they're requiring borrowers to submit when applying for a loan really either are kind of your third-party payroll forms, or in a lot of cases, your tax forms pertaining to that year. So 2019, people are obviously going to have access to at this point, but if you choose to use 2020, that may just cause some timing issues with when your 2020 tax information is going to be ready. given that we're sitting here right now in late January. That might not be ready for another month or two. You may need to work with your tax preparer to try to expedite that process in order to get that, if that's going to create a substantial change in what loan amount you may receive. So, but for farmers and ranchers, if you had no employees, essentially your loan amount is capped at a maximum of $20,833. And the way that that is calculated, you can see on the slide, but essentially it's annualized at $100,000 for that particular year, 2019 or 2020. You can't go over $100,000, and then you divide that just by 12 for the number of months, and then multiply that by 2.5. So, Erica, did I miss anything else there from a farmer and rancher's perspective?
Yeah, so one of the other changes specific to farmers and ranchers is the opportunity to use gross income as opposed to their net self-employment earnings, which is Schedule C, folks, and Schedule F until this act have to use their net income from self-employment. And for farmers, a lot of farmers, that's a big zero after depreciation and a number of other costs. So recognizing that a special allowance has been made for them to use gross income as opposed to that net income number. It doesn't apply to Schedule C people. It only applies to Schedule F people. But it will help a lot of farmers, or as they say in other parts of the country, ranchers.
Thanks, Erica. So, Erica, do you want to go over some highlights on the second draw loans?
Sure. So, in the Economic Aid Act, you heard a lot of talk leading up to it about how there were still businesses who needed help. Even the title says hardest hit businesses. A lot of those hardest hit businesses are in the hotel, accommodations industry, and the food service and restaurant industry. Not that there aren't a lot more, but that's certainly some of them. So Congress authorized a new loan, a second draw loan. It's another Paycheck Protection Program loan. It's governed by almost all of the same rules that John was just talking about the first ones. You special requirements to be eligible. The first draw loans, you could have 500 or fewer employees. Now this relates to 300 or fewer employees. The biggie here is that you have to have had a reduction in quarterly revenue from 2019 to 2020 of 25% or more. So if you look at your second quarter 2019 and you made $100,000 in revenue, and you look at your second quarter in 2020 and you made 75,000 or less, then you are going to have that 25% or greater revenue reduction. You can use any quarter in 2020 to compare to any quarter in 2019. You can also do it on an annual basis, although the documentation requirements for that are a little troubling on the annual basis. The other requirements are that you've got a first round loan or a first draw, and that you've used it or will use it. I can't imagine anybody that received one since the last date to get one was August 8th of 2020 hasn't already used it. There is a has used or will use the full amount of the draw, correct? And they have issued applications, and those are available on Treasury's website. And they have tried to simplify those applications some. So it is also interesting, I think, John. I'm trying to make sure I'm not getting ahead of myself on my slides. Yeah. What documents you have to submit. So let's talk about, ineligible entities. Everybody who was ineligible first time is ineligible this time. subject to the exceptions of the 501c6s, the housing cooperatives, the destination marketing organizations. And there are a couple of other organizations that would be disqualified, which includes organizations incorporated or with significant participation from China or some parts of Hong Kong, as well as organizations that have a 20% or more controlling interest by a member of Congress, a secretary of cabinet, or the president or vice president of the United States. So quarterly revenue reduction. Okay, that's great. Well, how do you define revenue reduction is the question that comes up. And the language they use is gross receipts. And they've defined it, which is helpful. I've tried for many years not to apply logic to anything related to governmental statutes or regulations because that almost always fails you. So don't try to categorize this as, oh, well, that looks like taxable income or that looks like this income. Just go with the words on the page. So generally, all revenue, love that. And then you get down to the last line of the first bullet, excluding net capital gains and losses. Under the do not include, if your gross receipts include sales tax that you've collected for an from your customers to remit to the government, you don't include those. You don't include intercompany transfers. And you can see the other very specific types of things that are not included. This is the definition for-profit entities. There is a slightly different definition for non-profit entities. And there is mind-numbing detail about which lines from your tax return you add together to get to the nonprofit gross receipts deduction. So overall, once again, we're looking at everything. And there is some disconnect between the definition for profits and nonprofits that I frankly don't understand. But when it comes, for example, to sales of assets, net capital gains and losses excluded on the for-profit side appear to be included over here. So when you're comparing whether or not your revenue has been reduced that 25%, then these are the definitions when you're looking at that revenue, the definitions you use to determine whether or not you meet that criteria.
Yeah, Erica, I think it's important to also point out just when we think about, all the bullets at the bottom of this slide that list out, what are these gross amounts, right? That it's really without regard for any expenses associated with those gross amounts. So you're really supposed to look at, when you go and you sell an asset like say you're selling, a tractor or whatever it might be, and you have to list that tractor, you have to pay somebody to help you sell that. And you received, $20,000 for that, but maybe you incurred $5,000 of expenses to do that. What you're really looking at is that $20,000 actual gross amount received, not the net of $15,000 when you think about any expenses. And that's the same across the board for all of those bullets down there that, any expenses incurred are not supposed to net against that gross amount, but you're supposed to only include those gross amounts, correct?
That's right. And that's one of the places where it's inconsistent with the for-profit and where I really don't understand why, especially on the sale of assets. That I don't know why you would be compelled to include your gross receipts from your sale of assets, your gross receipts from your investment income. I mean, that some of that just it's not logical, but
yeah, I think the other thing that's important too for nonprofits to keep in mind is that in the parentheses down there, including UBI activities. So you think about your unrelated business activities, you need to include those amounts as well in gross receipts.
okay. So Both first and second draw loans include the 60% threshold for payroll costs. In other words, to achieve full forgiveness, you have to spend at least 60% of the total loan amount on payroll costs. Recall that payroll cost includes gross wages, the employer contributions for health insurance, which has been expanded to include life, dental, vision, and short-term disability, employer contributions to retirement plans, and state unemployment taxes. And then your loan size is based on who you are. 2.5 times your monthly payroll costs for 19 or 20, or a 1-year period before the loan date. And I think John said the other day, if you're clairvoyant and you can predict when loan is going to be dispersed and you can choose a 1-year period before that, then that would be the 1-year period. That's a little tough. And not to exceed $2 million if you're part of a corporate group, which has its own definition, of course, and you can imagine some sort of common ownership, then you're limited to $4 million for the whole group. If you are an NAICS 72 entity, which is someone in the accommodations or food services industry, then you get to multiply your average payroll by 3.5 instead of 2.5. So again, this is what's the word I'm looking for? Trying to provide relief to those folks in the restaurant, hotel industries that in a lot of ways have been very, very hard hit. So those are your calculations. That's how you get to your loan amount. And then I wanted to say one thing about economic injury disaster loans. So you may remember that the economic injury disaster loan program precedes COVID-19. And it's what is available through SBA when hurricanes, fires, all those horrible things happen. It was the first relief to become available to people hard hit by COVID-19 because it preceded Paycheck Protection Program loans. They ran out of money fast, had a second authorization for Congress, now have a third authorization through these bills. You have now until 2021 or the money runs out to apply. If you're eligible, SBA under the first round had 3 days. Woo, that's quick to give you the money. Now they have 21. If you're not eligible, they have to tell you, as opposed to just kind of like leaving you hanging. And they have to do that within 21 days. And then I think the big deal for Paycheck Protection Program borrowers is that in the outset, in the first round in the CARES Act, the amount of your forgiveness for your PPP loan was reduced by the amount of your EIDL, your EIDL advance. Those advances ranged from $1,000 to $10,000, depending on when you got the advance. So you might have had a $300,000 loan, spent all of the money properly, kept your employees employed, didn't cut anybody's pay. You had a $10,000 EIDL advance, so your forgiveness amount was $290,000 and you were expected to pay back the 10. The act, retroactive, the Economic Aid Act, says, nope, never mind. You don't have to pay back that 10. We're going to pay the 10 to the lender. If you have already made payments, the lender will repay you those payments plus interest. So that's really good news for everybody, and that applies going forward as well.
So Erica, just a couple questions as I think about kind of second draw loans. One, when you think about your loan amount, is there any sort of threshold that's out there for like corporate groups about like how much they can receive in total?
Yeah, $4 million in total for the corporate groups, right?
Yeah. Okay.
It turned out to be 10 million implemented late for the first draw loans and remains 10 million. But it's far reduced this time to $4 million.
And then as borrowers are going to apply for these second draw loan amounts, when you think about, I think one of the first slides that you covered, that eligibility criteria to have used or will use the first draw loan amount. Are you hearing anything from banks about any certain documentation? Like, are they requiring borrowers to apply for forgiveness or
Yeah.
receive forgiveness before they're able to apply for a second draw loan?
Yeah, so while it's not part of the law, we have had and know that some lenders are requiring a forgiveness application. It's really interesting too, John, because before they'll authorize that second draw loan, and one of the reasons is just a basic business reason for the lender. As of maybe the end of the year, only about 30% of the loans that had been extended had only forgiveness applications had only been submitted on about 30% of the loans that had been made. And so borrowers don't get their money until the forgiveness application is submitted. So this gives lenders an opportunity to encourage their borrowers to submit that application so that they can get their money from SBA, replenish their funds. So it's not part of the law, but it could very well be a requirement that you run into.
Yeah, I read in, I think, one of the more recent IFRs. I mean, it feels like there's been a slew of new guidance over the past week or so, that if you were looking for a second draw loan amount in excess of $150,000 or more, that you would be required to at least submit your forgiveness application for your first draw loan before you can go and apply for your second draw loan. Now, that doesn't mean that you have to receive forgiveness from the SBA for that, but you at least have to submit your forgiveness application, so that some banks are actually looking at that as part of the documentation requirements and saying, okay, if you're going to apply for this second draw loan, we want to see a copy of your loan forgiveness application along with your application that you're submitting. Now, how that is put into practice with people that may have already submitted an application for a second draw loan before this new guidance came out, I don't know if they're going to hit pause on those or if the SBA is going to kick those back and say, no, we want to see the forgiveness application. I think that will kind of remains to be seen, as far as, our borrower is going to be asked to then, submit a loan forgiveness application for their first draw loan if they already have a second draw loan application in process.
Yeah. And just one point to make here to hopefully relieve some anxiety. It is not anticipated quite through 280 funds for first and second round loans was authorized. It's not anticipated that those funds would run out. An analysis of the number of loans that have been applied for and made in the first 2 weeks of this program, this 2021 versus the first round in 2020, the volume is much smaller, much smaller. And so whereas I'm not suggesting anyone delay, just don't have a heart attack or otherwise stress yourself, stay up late nights, just in the normal course of business, with as much expediency as you can, work on that forgiveness application, get that in so you can get your second draw. Also, I'd ask my lender if they'd take my application and just hold it until I get my forgiveness application in so that I'm in the queue. I don't know if they would or not, but it'd be worth the question.
Mm-hmm. It's a good point.
So enough about PPP loans, you think?
That was a lot of information, but I'm glad Maddie's joining us today, because honestly, Erica, as many questions as you and I have fielded about PPP loans and helping people out, I think either second or maybe equal amount of questions on the employee retention credit and them allowing people who received a PPP loan to now go back and potentially, receive a retention credit as well. At least for me, that seems to be a very hot topic with a lot of people that are reaching out to us for assistance.
So Maddie, talk to us.
Yeah. Well, along those lines, I think you sort of hit the nail on the head there, John, with renewed interest in the employee retention credit. Of course, it was initially enacted by the CARES Act, but the big news with the law that passed at the end of December was opening up the potential to take an employee retention credit for PPP borrowers, which I'll talk about in just a bit. But first, just kind of some general information on what the employee retention credit is. So it is a refundable payroll tax credit. So it's not an income tax credit. It's actually a credit that you take on your payroll tax return for employers who meet the eligibility criteria. That's taken against their share of Social Security tax. It's refundable, so that means that if the credit exceeds what your tax liability is, you're going to get the excess back as a refund, which is part of what makes it so valuable. As I mentioned, it was created back in March with the CARES Act, the same law that created the PPP program. And it was recently enhanced and extended by the Taxpayer Certainty and Disaster Relief and Disaster Tax Relief. I keep wanting to forget that tax there. Disaster Tax Relief Act that passed at the end of December. And so we'll talk about what some of those changes were. So I'll start off with what I'll call the 2020 ERC, because the employee retention credit, when it was initially passed, when it was initially enacted as part of the CARES Act, was intended to run through the end of 2020. And then the law that passed at the end of the year extended it into the first and second quarters of 2021. But as we'll see, there are some differences between what I'll call the 2020 ERC and the 2021 ERC. So we'll start at the beginning, the most logical place, with the 2020 ERC. And so as that was created by the CARES Act, the credit is equal to 50% of qualified wages, and we'll talk about what those are here in a minute, paid after March 12th, 2020 through and including December 31st, 2020. And the CARES Act capped the qualified wages that can be taken into account per employee at $10,000 for all calendar quarters of 2020. So you'd be looking at the entire year. The most that you could take into account for any one employee would be $10,000. And because the credit is 50% of that, you're looking at a maximum credit for 2020 of $5,000 per employee. So still, though, could potentially be very valuable depending on how many employees you have, could be a very big benefit for you. So those are the basics. Now, who's eligible for the employee retention credit? Because you do still have to meet the eligibility criteria. But generally, it's any employer that was carrying on a trade or business in 2020, regardless of size. There are no size limitations, although we'll see that the credit is calculated a little bit differently depending on how many full-time employees you have. And it includes tax-exempt organizations as well, as long as the business meets one of two criteria. So during the calendar quarter, the operation of that business either has to be fully or partially suspended due to a coronavirus order from the government that limits, commerce and social gatherings, things of that nature, or the employer has to have a significant decline in gross receipts. And I'll get into that in just a bit, what constitutes a significant decline in gross receipts. That first criteria is a little bit more subjective. I'm not going to go into a ton of detail today, but I mentioned the IRS frequently asked questions, and there are a lot of FAQs on, well, what does it mean, for instance, to be partially suspended? What if my business is open for some reasons, but I'm shut down for other reasons? Am I partially suspended? And the IRS has some examples on that, some things that they would consider to be a partial suspension, some things that don't quite fit the bill that they say, just having to modify your operations, but still being able to basically kind of conduct them in the same manner is not a partial suspension. So definitely check those out if you have questions on that, or if you fall, kind of within that bucket. If you're somebody that can meet the gross receipts test that I'll talk about in just a little bit, I think that's a little bit more objective than the government order test. So just something to keep in mind. There are a few kind of buckets of employers who aren't eligible. Government employers aren't eligible, and that includes the federal government, state and local governments, and any government agencies and instrumentalities as well. I put a little asterisk there because I'm going to revisit that with the 2021 ERC, because there are some exceptions to that government agencies and instrumentality rule when we get to 2021. And then self-employed individuals also aren't eligible, although if they have employees, they could be eligible for a credit based on the wages that they pay to their employees.
Maddie, I think that's a big or there too, just for people to keep in mind that it's one of those two
Mhm.
criteria. You don't have to be fully or partially suspended and have a significant decline in gross seats. So people just need to be mindful of that.
That's right. That's exactly right. That's a great point. It's either or. So you don't have to meet both prongs of that test. As long as you meet one, then you would be considered an eligible employer. So what's a significant decline in gross receipts? Bear with me here because it's going to be a kind of a lot of information, but what the CARES Act said is that significant decline in gross receipts begins with the first quarter in 2020 for which your gross receipts are less than 50% of your gross receipts for the same quarter in 2019. So you would, for instance, be comparing Q1 of 2020 to Q1 of 2019, Q2 of 2020 to Q2 of 2019, and so forth. And you have to show a more than 50% decline in your gross receipts. Once you hit that threshold, you continue to be eligible for the credit until the quarter after the first quarter for which your gross receipts are more than 80% of gross receipts for the same quarter of 2019, or the first quarter of 2021. Now, remember, we're talking about the 2020 ERC. That was how the law was written. But as I'll talk about, that the credit has been extended into the first two quarters of 2021. So I think that second bullet point there is important to keep in mind too. So your eligibility doesn't end until the quarter after the first quarter for which your gross receipts are more than 80% of what they were for the same quarter in 2019. So if let's say you first become eligible in the second quarter of 2020, you have more than a 50% gross receipts decline. And then let's say for the third quarter, your gross receipts are 60% of what they were in 2019. And then for the fourth quarter, your gross receipts are 90% of what they were in 2019. Even though you're more than that 80% threshold, you would still be eligible for the fourth quarter because your eligibility doesn't end until the quarter after the quarter in which your gross receipts get to be above 80% of what they were in 2019. So just something to keep in mind there as well.
So Maddie, aside from all the percentages and dates, which honestly, Erica, makes my head spin a little bit and makes me have just fond memories of all the dates and reference periods for the FTEs and employee salary and wages declines with PPP loans. But thinking about the employee retention tax credit here, Maddie, what if like you're in the second quarter of 2020 and you experience a gross receipts decline, or actually maybe the second quarter is a bad example, but the first quarter of 2020 where you have that March, 12th or whatever, that first
Right.
date. Does that mean that if I had a first quarter gross receipts decline, after March, like in that first calendar quarter of 2020, that I get to take the full quarter there, or is it just the period after the begin date?
That's a great question and a great point to clarify. So you would look at that whole first quarter to determine whether you are eligible. If you meet the eligibility criteria for the first quarter, meaning you have more than a 50% decline comparing that quarter to Q1 of 2019, you could still only take the credit on wages paid after March 12th. So they're really only giving you kind of a tiny portion of that first quarter. I think that relates to the fact that the CARES Act wasn't passed until March, or wasn't enacted until March. So you don't get to take the credit on all of the wages paid in the first quarter, just after March 12th.
John, it just makes me grateful for Maddie. I mean,
That's right.
I can't hold any more dates, amounts, percentages, etc. in my head.
I think you've got enough with PPP world and all of those dates. And I can't think of how many times, sometimes we've said it's X and we thought, oh wait, that was a different program. Because you're right, there are so many dates and percentages and things to keep track of working through all of this. So we mentioned that the credit is based on a percentage of qualified wages. And so it's important to define what qualified wages are. Generally, we're looking at wages that are subject to Social Security tax that are paid in a calendar quarter in which the employer meets the eligibility criteria. So either the employer has a significant decline in gross receipts for that quarter, or the employer has operations that are fully or partially suspended by a government order. but only the period of time that the order is in force. So I think that's really important to keep in mind, that you can only count the wages paid until the order is lifted. So if the order, that is restricting you, the government order that maybe is shutting you down or suspending your operation, is lifted midway through the quarter, even though you were technically eligible for that quarter, you cannot count any wages paid after the date that that order is lifted. So that's important to keep in mind, and is a distinction with the government order test compared to that gross receipts test, because once you meet the eligibility criteria based on your gross receipts, you're eligible and can count wages paid for that entire quarter. So just something to point out there. And then in addition to wages, employers can also count the allocable group health plan expenses as well. So just something to keep in mind, that in addition to wages, you might be able to pick up some of those amounts too. Another wrinkle to the qualified wages definition, I mentioned a little bit earlier that although the credit is available to employers of any size, there are some distinctions with what I'll call large employers compared to smaller employers with respect to what's considered qualified wages. So for employers that averaged 100 or fewer full-time employees in 2019, you can count all wages paid during the time that you meet the eligibility criteria. For who I'll call large employers that averaged more than 100 full-time employees in 2019, you can only count wages paid when the employees are not providing services. So that's really important. If you fall into that large employer bucket, you're only going to be able to count as qualified wages, basically wages that you're paying people for not to work. And so that's something that's important to keep in mind. And the IRS FAQs I mentioned earlier do have some information on if you think you're kind of close to that threshold, but you're not sure, how you calculate how many full-time employees you had in 2019. I'll say that the definition of full-time employee for the employee retention credit is different than the definition for full-time employee for PPP purposes, because of course they just had to make it a little bit more complicated. So definitely, if you think you're close to that threshold, it's important to check out the guidance to see where you fall. And then qualified wages don't include any of the Families First Coronavirus Response Act sick or family leave wages. So that was another program created by the CARES Act that allowed employers that had employees who were out on sick or family leave for certain coronavirus related reasons to be able to be reimbursed for those wages through payroll tax credits. And you're not going to be able to double up on those credits. So if you're counting wages for FFCRA sick and family leave tax credits, you can't also count those wages for the employee retention credit. Similarly, wages that are eligible for other tax credits, like the work opportunity credit is an example. You can't double up on those wages either. And then wages paid to certain related parties don't qualify for the employee retention credit either.
So Maddie, one more question for you, and I'm sorry, I'll let you speak at length instead of chiming in every slide here. But questions. If I'm somebody listening to this and I'm a large employer, meaning I know for sure I have over 100 FTEs in 2019, and I didn't pay any of my employees to basically not work during 2020. So I didn't furlough employees and have them sitting at home, and I was paying them to not provide any services or come into work. Is it fair to say that if I'm over 100 FTEs and I didn't pay anybody to not perform services, that essentially the employee retention credit might not be for me?
I would say for 2020, that's probably right. I mean, because you can only count wages you paid to people who weren't working, and if everybody was working and you were paying them to work, it sounds like for 2020 that might not be very valuable, if at all, for that employer. I will say keep paying attention for 2021, because that threshold is increased. And so even though you might have had more than 100 full-time employees, they sort of relaxed, they bumped that threshold up for 2021. So it could be that you could potentially benefit from the credit in 2021. Just another note, and I guess this is a kind of a good segue into the next slide here, dealing with aggregation. So aggregated employers are treated as a single employer for all aspects of the credit. And so that would include, for example, figuring out whether you had more than 100 full-time employees in 2019. If there are two employers that you have to aggregate and treat as one, you have to count all of their employees of both of those employers. The same thing when you're determining if you've had a significant decline in gross receipts or if your operations were fully or partially suspended. And typically when we're talking about members of an aggregated group, we're thinking of, parent and subsidiary, brother, sister control groups, combined group corporation rules that are typically based on more than 50% ownership, overlapping ownership. And there are similar rules for non-corporate entities like partnerships, trust estates, sole proprietorships. And then the IRS guidance also mentions some affiliated service group rules that are used for purposes of retirement plans and other employee benefits. So if you have more than one entity, just be sure to keep that in mind. It might be possible that you've got overlapping ownership, that you've got to treat those two entities as one, and that can affect your eligibility for the credit. So what's new for 2020? Everything that I just talked about was all sort of part of the initial CARES Act enacted in March, and those were the rules of the employee retention credit as we knew them until the end of December when the new law passed. And the Taxpayer Certainty and Disaster Tax Relief Act made some changes to the 2020 employee retention credit that were retroactive, meaning they applied as if they were written in the CARES Act back in March. There were a couple of changes that were just more, I guess, along sort of the clarification lines as opposed to introducing something totally brand new. So the law clarified what gross receipts means for tax exempt organizations. It actually referred to a section of the Internal Revenue Code just to clarify what those types of organizations should think about when they're considering if they had a gross receipts decline. And then it also made a clarification dealing with health plan expenses. And so the law said if you have employees to whom you're not paying wages, so maybe you furloughed an employee and you're not paying him or her anything, but you've continued to pay health plan expenses, you've continued to pay that insurance premium, you can still count those allocable health plan expenses even if the employee isn't being paid other wages. So the new law clarified that. That was actually consistent with some guidance that came out by the IRS I think several months ago, but just helpful to also have that in the law as well, which was consistent with the IRS guidance. And then, of course, the biggest news was that PPP borrowers are eligible for the employee retention credit. That's something we've been alluding to throughout the presentation today, because, of course, before this law passed at the end of December, a lot of employers really didn't pay the ERC much attention because they knew they got a PPP loan and it was off the table for them. So this new law actually retroactively back to the effective date of the CARES Act says, just because you got a PPP loan, that doesn't mean that you can't also benefit from the employee retention credit as long as you otherwise meet the eligibility criteria. With the caveat, and this is going to be the tricky part, is that wages that you use for PPP loan forgiveness, you cannot use when calculating the employee retention credit. I'll get into that a little bit more, but I think we still need some guidance in that area as to what wages. So for instance, if you've already submitted a forgiveness application for your first round PPP loan, and a lot of people, because you were allowed to use 24 weeks, they had payroll costs well in excess of their loan amount, but they might have put those on that loan application because they wanted to ensure they got maximum forgiveness. So they just put all of their payroll costs for that cover period on their loan application. Well, are all of those payroll costs, are all of those wages now off the table for the employee retention credit, or only the wages that you needed to get full forgiveness? And that's a question that we don't have the answer to yet. We're still waiting for some guidance from the IRS on how all of that is going to interact.
And we do know, Maddie, that the American Institute of Certified Public Accountants have asked the IRS specifically that question. I guess a little over a week ago. So hopefully we'll get something sooner rather than later.
Right. We hope so. I have been checking diligently the IRS website, waiting for more guidance. And as we're talking right now, unless they have issued something as we've been on this webinar, it hasn't come out just yet. So how do you claim the employee retention credit? I mentioned that it's a payroll tax credit, and that means it's claimed on the payroll tax return, which for most employers is going to be Form 941. For 2020, the IRS did come out with some guidance that said, in anticipation of receiving these credits, employers could reduce their employment tax deposits by the anticipated credit. And if that still wasn't enough, they could request an advance payment on what's called Form 7200. It didn't require employers to do that. So, they could, if they chose, just wait until they filed their Form 941 and take the credit on Form 941. And of course, Form 941 has been totally revamped to take all of this into account and to reconcile all of this on the form. And as I mentioned, we're still looking for some clarification on some of these items about how the PPP and the ERC interact. Another thing we're waiting for guidance on is how these PPP borrowers can claim the 2020 ERC for prior quarters, because they may have met the eligibility criteria in Q1, Q2, Q3, but of course they didn't claim the credit because the law at that time said they weren't eligible because they got a PPP loan. So now how do they go back and claim the credit for those prior quarters? There was some very limited IRS guidance that came out a couple of days ago because the law alluded to the fact that some employers might be able to catch up, so to speak, by including those amounts for prior quarters on their fourth quarter 941. And the IRS has come out and said, yes, but only if you meet some very narrow criteria. So you could sort of use that catch-up procedure if you are an employer that forgiveness and you included certain payroll costs on that application, and it ended up that your request for forgiveness was denied. And so now you want to go back and claim the credit on those wages. You could actually put those amounts on your fourth quarter Form 941. Or you could use that fourth quarter Form 941 to pick up some of those healthcare costs, because as I mentioned earlier, the law sort of clarified that if you, furloughed an employee and you didn't pay them wages, you could still count healthcare costs that you paid to them as qualified wages. But for other employers, like people whose forgiveness was granted, or maybe some employers who are still waiting to get a decision, there doesn't really seem to be a mechanism for those employers to go back and pick up the credit for earlier quarters on the fourth quarter 941. And I will say, I think the IRS guidance is consistent with how the law is written, although I'm not sure that's what was intended. So we're still waiting to see, how those other employers who maybe have, forgiveness that was granted go back and claim the ERC for earlier quarters in which they were eligible. I think the most logical thing would be that they would go back and amend the Form 941 for those quarters, but still waiting to just get confirmation on that from the IRS. So we talked about the 2020 ERC, and now I'll talk about what is new for 2021. The new and improved ERC for 2021, it was pretty significantly enhanced and expanded. And so the Taxpayer Certainty and Disaster Relief Tax Act extended the ERC to the first and second quarters of 2021. So now it's scheduled to end to run through, I guess, the end of June, which would be the end of the second quarter. PPP borrowers continue to be eligible to take the credit if they're otherwise eligible employers, with that same prohibition on counting the same wages for both programs. And then there were several prospective enhancements that I'll talk about here just in a second on the next slide. So this chart kind of compares, lets you see, 2020 versus 2021. What are the changes? The 2021 ERC does have the potential to be, I think, significantly more valuable. So when we talked about the 2020 ERC, that qualified wages threshold was $10,000 for all quarters, which meant an employer, the maximum amount of qualified wages they could take into account for any one employee for all of 2020 was $10,000, resulting in a maximum credit of $5,000 for 2020. For 2021, that increases to $10,000 per quarter. So for each of Q1 and Q2 of 2021, the maximum is $10,000. In addition, for 2020, the credit was equal to 50% of qualified wages. In 2021, that is bumped up to 70% of qualified wages. So if you think about it, for 2020, the maximum credit you could be entitled to per employee was $5,000. For 2021, that's a potential maximum benefit of $7,000 per quarter, which would be $14,000 per employee for both quarters if you were eligible, or if you are eligible for both quarters. That large employer threshold that we talked about, so that threshold to determine whether you can count all wages or if you can only count wages paid when employees aren't working. For 2020, of course, we talked about that was more than 100 full-time employees in 2019. And for 2021, it's more than 500 full-time employees in 2019. So you're still looking at 2019, but that threshold is increased. So for employers who maybe have between 100 and 500 full-time employees, this could be a significant benefit for them by allowing them to count all wages rather than just wages paid when an employee isn't working. And that reminded me, oh, and I think it's coming up, and I wanted to mention something about the gross receipts decline, which I'll cover here in just a second. So before I do that, government employers, so you'll recall that I mentioned back dealing with the 2020 ERC that government employers are not eligible for the credit, and that includes also government agencies and instrumentalities. For 2021, there are a few exceptions. So it's the credits opened up to 501c1 organizations, public colleges and universities, and then public entities providing medical or hospital care. So they did sort of relax that for a subset of, I guess you would call them government instrumentalities that could be eligible in 2021. And then what I wanted to mention was the gross receipts decline. So for 2020, if you recall, that began with the first quarter in which you had a decline in gross receipts of more than 50% compared to the same quarter in 2019. For 2021, you only have to show a decline of more than 20% looking at that quarter in 2021 compared to the same quarter in 2019. So that's an important thing to note there, is that you're looking at 2021 versus not 2020, but 2019, because they wanted to recognizing that a lot of businesses may have had decreased gross receipts in 2020, they wanted to, allow businesses to look back to sort of that pre-COVID time when they're determining if their gross receipts have dropped. And then one last thing, for 2021 only, employers can actually elect under the gross receipts test to determine their eligibility by looking at the prior quarter. So if, for instance, let's say Q4 of 2020, you had a gross receipts decline of more than 20% compared to Q4 of 2019, that actually could open up your eligibility for Q1 of 2021, because you could elect to look at that prior quarter. That was not an option in 2020. You could not elect to look at the prior quarter to determine your eligibility. So I think that I know in a very quick fashion covers a lot of the changes that we're looking at, but I do think the 2021 ERC has the potential to offer quite a bit of additional value for employers as we're looking at some of these changes.
Maddie, quick question, just on the 2021 ERC, does an entity have the ability to look at or compare against 2019 or 2020, or is it just 2019?
It is just 2019.
Okay.
Yeah, so you're just looking at 2019.
Terrific.
So we thank you very much for watching whatever portion you chose not to fast forward through, which was certainly an option I have exercised. So no shade being thrown there. You have our contact information as well as our solution email address. Also, I was thinking, John, you and I have been in the PPP world since March 27th of 2020. And a lot of what we talked today builds on that first program. And there's a lot of material out there about the first program. So if a lot of what we said to you, because you didn't apply the first time around, sounded like a foreign language, then I would encourage you to reach back. There are recorded webinars with me and John on our firm's website, keeping in mind, and the same is true of Maddie and her work, keeping in mind that there have been changes, but for some baseline language perhaps, or a baseline understanding, there should be resources out there that might help you. So we hope you have enjoyed, to the extent that someone can enjoy a presentation like this. We are pleased to be able to provide this service to you and the business community, and encourage you to reach out to us or another financial advisor in the event that you need help to make it through this difficult time. So thank you all very much.
Thank you.
Thanks, everyone.